Well, growth stocks still have been dominating Wall Street gains this year, thanks in part to artificial intelligence. Our next guest says there's opportunity in growth names outside of the tech sector. Joining us now, Jennifer Grancio, TCW Head of Global Wealth. Great to see you. Thanks so much for coming in. And this is obviously a theme that we've talked a lot about this week, that the mega cap tech stocks have just been dominating. But your bag is sort of looking outside of that at other things here. So I guess, first of all, tell us your methodology and why you want to look outside of that mega cap growth.
Yeah, thank you. We'd be happy to do that. And if you think about it, everybody is so invested, and everybody's portfolio is so invested in tech and growth at this point. We think that it's always hard to time the markets. You can't be in cash vehicles forever. And so when you look at the equity portfolio, we're seeing huge transformations in the market. So we're seeing a transformation around energy, which is sources of powers, but also efficiency. So planes are getting more efficient. If somebody can manufacture a plane that's more efficient, they have huge pricing power and they have huge kind of opportunity to drive up the stock price. And so we run a range of strategies that are looking at helping people make money outside of that core tech portfolio, particularly as we look at one, transformation of how we use energy and power, and two, reshoring and this huge boom we're having in manufacturing in the US.
In commercial aerospace, that's one area. Explain that thesis to us.
Yeah, absolutely. And so if we think about how much we've invested or haven't invested, frankly, in the last decade in certain areas, commercial aerospace is one of those areas. So two investment opportunities. One, the planes we have up in the air today need a huge amount of maintenance. I think we've had 3 million people traveling just on Sunday. Highest travel day ever was this past Sunday. So air travel is coming back. Planes need to be serviced. So huge opportunity in names like GE that are actually manufacturing and repairing. And then if we look forward, there's a demand from consumers for efficiency. So new planes, Airbus's new planes use 20% less fuel, which is a huge savings and a huge edge, therefore, for companies that are buying the Airbus plane. So that's one of the themes that plays out in our portfolios.
Whenever we talk Airbus, I got to ask about Boeing too. So implied then is the idea perhaps that Airbus is doing a better job at this than is Boeing?
That's our thesis.
Okay, and just because that they are looking more to the future of having these more efficient planes?
The future and also how they run their business. So, Airbus is a business we think is very well run. We're active managers, so we run NetZ is one ticker, SUP is the other. They're very concentrated portfolios, and so we've known these management teams for a long time. In some cases, like in the waste management space, we own a couple of names. In the case of aerospace, we think Airbus is the one to hold.
And what could then Boeing be doing differently?
I think it's a combination of how they've run their business historically and how capable they are in terms of delivering in a reliable way from a forecasting perspective so that we can see that stock grow.
Let's talk about waste management since you touched on it. And this is an interesting one to me when I was reading your notes in advance of this, because you've always been focused on this sort of infrastructure play in the United States, right? But then, where does all the garbage go? Which is something I hadn't thought about. When you're doing these big projects, in other words, there's a lot that has to get hauled away. Is that what's going on here? Are these companies going to benefit from that?
They're going to benefit hugely. And so if you think about the market environment we've been in overall, it's been inflationary. These companies, particularly Waste Management and Republic Services, have dealt with that well. So they're coming out of this inflationary environment with good pricing power.
How have they dealt with that well? By raising their prices?
By having control of their prices and coming out of the current environment with the ability to increase prices further. So we start with that's good from a fundamentals perspective. And then if you look at this boom in manufacturing and reshoring, the country, if you look at a picture of the country, it's lit up like a holiday tree with mega projects up and down. And so when you do huge construction projects, only these huge waste companies can deal with the complexity, and in some cases, waste you need to handle very carefully from this huge boom in manufacturing. So they're huge beneficiaries there. The other thing we like, and the way we look at investments, is the intersection between different things we have going on. The garbage companies also have huge landfills, and each of them are building amazing businesses where they effectively are taking methane, carbon dioxide, they're recycling it, and they have over 60% internal rate of return on brand new businesses where they're generating natural gas. So very attractive across good fundamentals. They're well positioned for this huge boom in manufacturing, and also they've got some creative upside on the new sources of energy.
And just a broader question too, Jen, about ESG investing. It just became so politicized, Jennifer. How do you think that happened, and how do you think investing, ESG investing and the strategy just sort of evolves from here?
Yeah, I mean, I think my view on that and the firm's view on that would be the E environmental, S social, G governance. That was always meant to be risk data. So from an industry perspective, shame on the industry for naming products what were supposed to be, underlying risk data. And so the way we think about it is we look at the underlying risk data on every company. And if a company has an opportunity to kind of beat out a competitor because they can manage a risk better, that company should outperform over time. So we think about it as we're a performance investor, and we use the data and we're giving you alpha in return. And then there are other people that have a strong view on values, and that's great. You can always screen a portfolio in line with values.
Another sort of framing question, a different framing question. We began this conversation by saying, where can you find growth outside of tech? Do you think about the picks that you talked about as growth stocks? Are they value stocks? Like, how do we sort of get our hands around?
Yeah, the way we would think about it is we're always looking for companies that grow. So if you were to look at our portfolio, it probably is a blend portfolio that's a little bit more on the value side. But if we're right, that will be a growth portfolio over time. And so we're not looking for things that we don't think will appreciate. We're looking for things that are undervalued now and we think will have strong appreciation. And a lot of these industrials that we talked about and all of those different businesses, many of them are categorized as industrials, all of them have very strong fundamentals. And we think they're underpriced today. So today it looks a little bit more value. We think we're right, and they will be growth over time.